Now, this set of ratios will help managers assess their management of their debt. And really, they're trying to look at the ability of the company to pay all of its liabilities, both current and long-term. And so these will provide a measure of risk, because having a lot of debt is risky, because those people who own the debt, those other companies, those banks, can require you to pay that. All right, so we'll use the financial statements of Aggie Inc., the balance sheet, and the income statement. Find those in your lecture notes. First thing we'll look at is the times interest earned. And this is just looking at the ability to make the periodic interest payments as they become due. The formula is income before taxes plus interest expense divided by interest expense. So you add interest expense back because, when you compute income, you've already earned interest expense one time over. So we add it back. Sometimes this is calculated as net income plus income taxes. But, of course, that's the same thing as income before taxes. And then they add interest expense back. So don't let that confuse you. It's really the same formula. All right, let's turn, all of these numbers come from the income statement, so let's turn our focus to the income statement. We're going to start with the income before tax, the $10,000, and we're going to add the interest back of $2,000 and divide by $2,000. So all of this comes from the income statement. Numerator is 10,000 plus 2,000, and we divide by 2,000. So we get 6. Now this tells managers that Aggie's earnings were 6 times what it had to pay in interest on its debt. So the higher this is, the more likely that the company will be able to make those periodic interest payments. Now we'll look at the debt to equity ratio. This is just looking at the relative proportion of financing that is provided by creditors like banks and other payables as opposed to stockholders. So there's really 2 ways to finance your operations. You can borrow money, or you can use the stockholders' investment, either by issuing stock or retaining the earnings and using that to operate. So this is just looking at the relationship between the two. You'll take total liabilities and you'll divide by total stockholders' equity. This is all going to come out of the balance sheet. And so we'll just look at the balance of liabilities for the year and stockholders' equity balance for the year. And of course, we're looking at 20x2. You can see that I have all of the liabilities highlighted in yellow. Accounts payable, wages payable, taxes payable, and bonds payable. So this includes both current and long-term liabilities. Those liabilities add up to $41,000. The equity includes the common stock account, the additional paid-in capital on that common stock, and retained earnings. So total stockholders' equity at the end of the year is $52,000. So we can put this into the equation. $41,000 of liabilities, $52,000 of equities, and we get 0.79 to 1, or 79%. Liabilities were 79% of equities. So this company is using more equity than debt to finance its operations. So specifically, again, Aggie Inc.'s liabilities are 79% of its equities. If this had been a 1-to-1 ratio, then you're using equal amounts of debt and equity to finance your operations. But here, again, it's less debt than equity. So is a higher ratio more or less risky? And the answer is it's more risky because you're using more debt. Debt is definitely risky business because what can happen is you have to pay those liabilities. But when you finance with equities, those investors are not guaranteed anything. But when you finance with debt and you borrow from the bank, if you can't pay the bank back, they can come and seize your assets. And that would, of course, drive you out of business. So the more debt you're using, the riskier it is. A very similar calculation is called the equity multiplier. And this, again, is looking at what portion of the company's assets are funded by equity. You'll take average total assets over average stockholders' equity. Okay, so you can see the assets are $93,000 and $86,000. That's the average of those is going to go in your numerator. In your denominator, your ending stockholders' equity at the end of 20x2 is $52,000. Includes the common stock, the additional paid-in capital, and the retained earnings. At the beginning of the year, or the end of 20x1, those add up to $48,000. So we can put that into our formula. 93,000 plus 86,000, the average of that would be 89,500 of assets. The average equity, 52,000 plus 48,000 divided by 2. Average equity would be 50,000. And this would give us 1.79. So this too looks at what portion of assets are funded with equities. This one tells management more of the average over the year, whereas the debt to equity ratio looks at the end of the year. Now, I'm more interested in you understanding the meaning of that debt to equity ratio, but it's not hard to learn how to plug in to find the equity multiplier. But focus your understanding of this on debt to equity. Right, so managers have to assess their ability to manage their debt, and these ratios help them do that. And they want to make sure they're borrowing money only if it will benefit the stockholders. So think about this from two different perspectives. Creditors really prefer that a company have less debt and more equity, because that increases the chances that they'll get paid back if the company goes out of business. In liquidation, of course, liabilities get paid first, and then the shareholders get money if anything's left. So when a creditor is assessing whether they will let you borrow money, they're going to look at how much financing you're doing with debt already. And if it's too much, they may not loan you money. On the other hand, stockholders like debt if the return on assets is greater than the rate of return they have to pay to borrow money, like on their bonds or their mortgage payable. So that's how managers can at least evaluate on a more formal basis their ability to manage their debt.